every single day, forces you've never heard of are moving your money. The Fed, AI, geopolitics, currency wars. Most people only see the headlines, but they never understand the signal beneath the noise. That's what MacroSignal is for. Welcome to This Explainer. Today, we're looking at the invisible architecture of the new global economy. We're going to examine how one single company has amassed the exact same structural power as a central bank, but over the raw currency of the artificial intelligence boom. The Federal Reserve controls the supply of money. Jerome Powell can raise or lower rates with one decision, and every bank, every market, every economy in the world basically has to respond. Now ask yourself, what if there was a company that had that exact same structural power? Not over money, but over the one resource the entire AI economy literally cannot function without. Well, there is. It's called Nvidia. Jensen Huang has never raised interest rates, but his decisions about how many chips to produce, who gets them first, and at what price move more capital today than almost any central bank on Earth. And unlike the Fed, nobody elected him. Compute power is the new global reserve currency. If you want to build the future, you have to pay the toll. And right now, Nvidia holds an absolute monopoly on the money printer. To really understand how they pulled this off, we have to look at how they've engineered their financials to mirror the power of an actual sovereign state. Section 1. The money printer, seigniorage and gross margins. In macroeconomics, there's this term called seigniorage. It's basically the profit a government makes simply from having the right to print currency. Well, Nvidia has essentially achieved seigniorage in the hardware space. Look at this. At its peak, Nvidia commanded an 88.1% gross margin on chips like the H100. Let that sink in. It costs about $3,320 to manufacture, but they sell it for roughly $28,000. That isn't just a healthy profit margin, right? That is mathematical proof of absolute pricing power. So what does the macroeconomic impact of that kind of pricing power actually look like? It looks exactly like this. Over just 3 fiscal years, Nvidia's revenue violently spiked from $60.9 billion to an astonishing $215.9 billion by fiscal 2026. This isn't just a tech company having a good quarter, guys. This is a fundamental rebalancing of global capital flows. But, it begs the question, how do you defend an empire this lucrative? Simple. You build an inescapable ecosystem. To understand Nvidia's unassailable moat, you absolutely have to understand CUDA. It's not just some software platform. Think of it as the global reserve currency of the AI developer ecosystem. We're talking over 4 million developers completely locked into this framework. Because every major machine learning framework was optimized for CUDA first, trying to switch to a competitor isn't just expensive, it literally sets your engineering timelines back by years. You see, Nvidia's dominance isn't just about making really fast chips. It's a massive, multi-layered structural moat. First, they have a 20-year head start on CUDA. Second, they offer a full-stack platform, hardware, networking, and software all tightly integrated. On top of that, they hold an iron grip on about 60% of TSMC's advanced CoWoS packaging capacity. They literally control the bottleneck that dictates how many chips their competitors can physically manufacture. No way around it. And now, they're partnering directly with governments to build sovereign AI infrastructure. They are effectively negotiating with nation-states right now. Section 2, the inflation crisis, the cost of inference. But hey, no empire lasts forever without facing a crisis, right? For Nvidia, the looming threat isn't someone building a better chip. It's the astronomical inflation of AI inference. Let me explain. Nvidia built its multi-trillion-dollar empire on training AI models. Training is a one-time capital expense, say around $150 million for something massive like GPT-4. But inference, which is the act of users actually querying the AI every single day, that is an eternal, compounding operating expense. Over its life cycle, running that exact same model could cost upwards of $11.5 billion. It's a completely different game. And here is the structural flaw in Nvidia's monopoly. Nvidia GPUs are the undisputed kings of training because they're incredibly flexible and programmable. But running endless daily queries at hyperscale, that doesn't require flexibility. It requires ultra-low latency and extreme power efficiency. Nvidia's core architecture just wasn't perfectly optimized for the strict power and cost constraints of running trillions of queries day in and day out. This total cost of ownership math is causing industry-wide panic right now. Let's break it down. A mid-sized deployment of Google's custom TPUs costs about $78.5 million over 3 years. The equivalent Nvidia H100 cluster, $177 million. That is nearly $100 million in savings, driven entirely by cheaper hardware and radically reduced electricity consumption. At hyperscale, folks, this isn't just an inconvenience, it's a full-blown cost crisis.
Section 3. The TPU Rebellion, Fleeing the Reserve Currency.
So when inference becomes 15 to 100 times more expensive than training, companies understandably get desperate to escape the Nvidia premium. What we're watching right now is a rapid defection of key players, literally fleeing the reserve currency. Look at the timeline. In mid-2025, Midjourney silently moved their workloads to Google TPUs, cutting their inference costs by 65%. By November, Anthropic committed to hundreds of thousands of TPUs. And even Meta, who has historically been Nvidia's biggest customer, entered multi-billion-dollar talks for Google's custom silicon just to hedge their bets. The data perfectly illustrates this shift. Nvidia's peak 87% market share is slowly but surely eroding. By 2026, custom silicon and ASICs, which are chips designed specifically for singular, hyper-efficient tasks, are projected to eat up nearly 28% of the AI server market. The hyperscalers have realized they need to build their own money printers. But remember, you don't become the central bank of AI without knowing exactly how to fight back. Nvidia's countermeasure is the recently unveiled Vera Rubin platform. Their explicit promise here? Up to a 10x reduction in inference token costs compared to the previous generation. They are aggressively trying to slash the inflation of AI compute to crush this TPU rebellion and protect their massive market share. Section 4. The path to 20 trillion. So if training is a one-time event and inference is forever, how does Nvidia possibly continue its explosive growth? Tech analyst Beth Kindig from the IO Fund makes a great point. She argues that the path to a $20 trillion valuation won't come just from selling more raw hardware units. The future relies entirely on dominating system-level token economics, essentially owning the platform that yields the highest computational output for the absolute lowest cost. The new battleground is all about efficiency at scale. Because of this, Nvidia is rapidly evolving from a traditional hardware manufacturer into an inescapable full-stack infrastructure monopoly. They're expanding heavily into AI-native software and robotics. Believe it or not, in just a few years, they've actually overtaken Broadcom to become the world's largest Ethernet networking company. And they are significantly deepening their ties with sovereign nations to build state-backed AI factories. They aren't just selling chips anymore, they are monetizing the entire system. The AI economy is fundamentally pivoting from the explosive capital expenditure of training to the grueling, margin-obsessed reality of inference. So here's the big question to leave you with. Can Nvidia's relentless innovation and deep software moats maintain their reserve currency status? Or will the rise of cheaper custom silicon permanently devalue their empire? The headlines are always going to tell you about the stock price, but now you actually know the structural forces moving the market beneath the surface. Keep watching the signal, not the noise. Thanks for joining me on this explainer.